Hey traders, welcome back to the channel. Today's video is all about call credit spreads. This is a way that you can make money even if the market goes down, sideways, or even up a little bit, but it's a bearish strategy, and I'm going to show you how you can make money with a call credit spread. Alright, so a call credit spread, this is a bearish strategy, and you want to use it when you believe the stock or the market is going down or sideways. One thing it does is that it limits your risk, and we'll get into the mechanics of how it works and how it limits your risk further on down in this video. There's less capital or collateral required, so it's great for small accounts to grow. You don't need as much capital, and you can limit your downside. So the goal is to have the stock price below the short strike price. So how this works is that you sell a call at a strike price that is above the currently trading price. This is known as the short. And simultaneously, you buy a call at a higher strike price, and this is known as the long. And we'll go through a real live exercise with this, but let's say we're trading Tesla, and right now the current price is 181. You would sell a call at the 195 strike price, and then you would simultaneously buy a call at the $200 strike price. So if the price of the stock goes down, you make your full profit, and if the price of the stock goes sideways, you'd still make your full profit. And even if the stock goes up a little bit, you would still make your profit. So there's a lot of wiggle room here where you can make a full profit, keep your risk low, keep your collateral low. And we'll look at an example right now. Tesla currently trading at around 181. And let's go trade Tesla options. And what you would want to do is go sell, call, pick your expiration date. I'm going to go out to May 17th, which is 12 days away. And let's go up to the 195 strike price. So that would be $2 per share that I would collect in premium there. The delta is around 0.22, so that's within my range. And then what you want to do is go buy a call, and I'm going to go up to the 200 for this example, and I would have to pay $1.29 per share, which means $129. So the profit potential here is the difference between the $2 that you collected for premium and the $129 that you paid. And that's $71. So again, with the current price of 181, so we sold a call at the 195 strike price. We collected $2 per share, or $200 for that. At the same time, we buy a call at the $200 strike price, which costs us $129 per share, or $129. And the difference is $71. That's our profit. And so the risk is $500, which is the difference between the two strike prices. 200 minus 195 is $5 times 100 shares is $500 less the premium that we collected, or $429. So that's our total risk. And the collateral required is the difference between the two strike prices, or $500. Now let's compare this to a traditional call option where we didn't have the long option involved. So typically you would need to own 100 shares and use that as collateral to make this trade. So that would cost you, let's say you wanted to buy the shares outright today, that would cost you $18,120. And if the share price at expiration went above your strike price, then those shares would get called away. So that's kind of the risk there. Now, when we say your risk is capped here, you can see that the max loss here gets around $400 and some dollars. Actually says here $424.50 on the option strat. Now, if we take away that long put, then your max loss is unlimited because there's no limit to how high the stock can go, and your option price will go up accordingly. But you never want to do a naked call option. You always want to have 100 shares as collateral so that if you go on the money, your shares will be called away at that price. So for example, with a naked call, you don't own any shares. Let's say the price shoots up to 210, but your call is at 195. Well, you would have to purchase the shares at 210 and then turn around and sell them at 195 to cover that. So that's why I don't ever recommend doing a naked call. And doing a call credit spread, by buying this option here, you're simulating ownership of the stock. So you don't need to own all those shares. And that's why this is great for small accounts to grow, because you can make a decent amount of premium. You don't make the full 200 here, you make the difference, but the amount of collateral that you need is way, way less. It's $500 versus $18,000. And also because you don't need as much collateral, you can do multiple contracts. So let's say you did 5 of these contracts, that would mean you can make up to $380. And you would just need the collateral of $2,500, and your max loss would be about $2,100. Let's go over some outcomes. So at expiration, let's say the price is below both option prices. Well, that means both options are out of the money and they expire worthless, and you collect the full profit. Scenario 2, if the price is above both strike prices, both are in the money, you incur the max loss, however your losses are capped. And the third scenario, that's where the price is in between the short and the long. That means the short is in the money and the long is not in the money. So if you're doing a naked call, don't do this, you'll be short 100 shares per option, and you're at high risk as we explained earlier. If you're doing a covered call, your shares will get called away, and you would incur a loss between your break-even and your max loss. All right, so let's talk about managing a trade. You could close it out if it gets close to or above your short strike price. A lot of people have a way in their brokerage of setting an alarm if it gets too close to your strike price. If you're short and you want to close it out, you can get a warning for that. But basically, Robinhood has a button where you can just close it out in one move. But with other brokers, in order to close this out, you would buy to close the call that you sold and sell to close the call that you bought. To reverse those, you could also roll it out further in time and adjust both legs, but that gets more complicated. I won't go over that in this video, but that's another option you could do to manage a trade. And you can close your trade out anytime before expiration. Let's say you've realized 70% of your profit, you want to move on. Well, you could just close this out, take your profits, and go on to the next trade. And that's it for this video on call credit spreads. I really hope you liked the video and got something out of it. If you did, please hit the like button and make sure to subscribe, and we'll see you on the next one.